Welcome to The Explainer. Today, we're diving into one of the most influential investing books ever written, The Intelligent Investor, to see why its wisdom is, well, pretty much timeless.
Let's just start with this quote. It's from Warren Buffett, arguably the greatest investor of all time, who said this single book literally changed his life. When the Oracle of Omaha says something like that, you kind of have to lean in and ask, why?
Okay, first things first, let's be super clear about what this book isn't. It is not a get-rich-quick scheme. Graham doesn't have any secret formulas for overnight millions, so if that's what you're after, this isn't it.
And it also just completely throws out the idea that anyone can perfectly time the market or predict what it's going to do next. You know, in a world that's screaming with hot tips and predictions, Graham basically says, that's a game you just can't win.
So what does it do? Well, it teaches you something way more powerful, something that lasts. It gives you a framework for how to think rationally about investing. It's not a list of rules. It's more like a mental operating system designed to keep you from making those big emotional mistakes.
All right, here's how we're going to break it all down. We'll start with the man himself, Benjamin Graham. Then we'll cover the huge difference between investing and speculating. We'll meet the famous Mr. Market, figure out what kind of investor you are, talk about mastering your emotions, and then wrap it up with lessons that are as true today as they were decades ago.
So first, let's get to know the master himself, Benjamin Graham. Because really, to understand his ideas, you have to understand where he came from. You know, Graham's entire philosophy was basically forged in the fire of the Great Depression. Living through the 1929 crash shaped his one central question: how do we protect ourselves from losing money? Everything else comes second. This focus on not losing money led him to create value investing, and it's what he taught to a young Warren Buffett at Columbia, who later said Graham was the second most influential person in his life, right after his own dad.
And all that experience led him to this one huge foundational idea: you have to know the difference between investing and speculating. Getting this right is the absolute bedrock of his philosophy, and man, is it relevant today with meme stocks and crypto crazes all over the place.
See, for Graham, the word investment had a really strict definition. It had to pass a three-part test. 1, you've done your homework, thorough analysis. 2, it promises safety for your initial investment, your principal. And 3, it offers an adequate return. Not spectacular, just adequate. If what you're doing fails even one of those, he says it's not investing. It's speculating. And this just lays it all out, right? The two mindsets. The investor is looking at the business itself, its real value, for the long haul. The speculator, they're just riding a wave of hype and emotion, staring at the stock price and hoping to make a quick buck. And here's the real kicker. Graham argued that most people who think they're investing are actually, without even knowing it, speculating.
Okay, now we get to what might be the single most famous, most brilliant idea in the whole book. It's a simple story that just perfectly explains how irrational the stock market is.
So Graham wants you to picture something. Imagine the market isn't this big, faceless machine, but instead, it's your business partner. And he calls this partner Mr. Market.
Now, every single day, your partner, Mr. Market, shows up. He offers to either buy your shares from you or sell you his shares. But here's the catch. His prices are based entirely on his wild, bipolar mood swings. Some days he's totally euphoric, offering you a crazy high price. Other days he's scared to death and will sell you his shares at a rock-bottom bargain price.
And here is the absolute key to the whole thing. You don't have to trade with him. You can just ignore him. His only job is to offer you opportunities, to serve you. You take advantage of him when he's panicked, and you can sell to him when he's ecstatic. But you never ever let his mood guide your own judgment. And that idea, it flows right into his #1 rule for protecting yourself from Mr. Market's craziness. You have to always insist on a margin of safety. This is your shield. Think about it like this. If you figure out a house is really worth $1 million, but you manage to buy it for $700,000, you have a $300,000 cushion. That buffer protects you if you made a mistake, if you have bad luck, or if the market just goes down. And psychologically, this is huge, right? We all know that losing money hurts way more than winning feels good. A big margin of safety is your defense against that feeling making your decisions for you.
Now look, Graham was a realist. He knew that not everyone wants to spend their life buried in financial reports. So he laid out two totally different and totally valid paths for an intelligent investor.
On one side, you have the defensive investor. They want a simple, safe, hands-off approach. Their goal is basically to avoid big mistakes, usually by doing something simple like automatically investing in low-cost index funds. Then you have the enterprising investor. This is the person who's willing to put in the work, to dig through the numbers and find those rare, undervalued companies that everyone else has missed.
But here's the thing. One isn't better than the other. The real trick is being brutally honest with yourself. Which one are you? Which one fits your time, your knowledge, and your personality? Because trying to be a mix of both without knowing who you are, that's just a recipe for disaster. And this brings us to what Graham believed was the final boss of investing. And it has nothing to do with the stock market or the economy. Nope, it has everything to do with you. He said it flat out. The investor's chief problem, and even his worst enemy, is likely to be himself. It's your own emotions, fear, and greed that are way more dangerous to your money than any market crash could ever be. Getting a handle on them is the final and toughest skill to learn. So, okay, how do we actually use this stuff? How do we take this wisdom from decades ago and make it work for us today? And just as important, how do we boil these ideas down so we can pass them on to the next generation? All right, here are 4 things you can start doing, like right now. First, always remember there's a difference between a stock's price and a company's value. Second, learn to tune out the daily noise and headlines. Third, always demand that margin of safety. And fourth, know yourself. Your behavior is way more important than how smart you are. And if you wanted to teach these ideas to someone, maybe your kids, you could start right here. Number 1, think for yourself. Just because something is popular doesn't mean it's a good investment. Following the crowd is the opposite of finding a margin of safety. Number 2, think like an owner, not a gambler. A stock isn't just a ticker symbol on a screen. It's a tiny piece of a real business. You should ask yourself, would I buy this entire company for its current price? If the answer is no, you probably shouldn't be buying a small piece of it either. Number 3, be patient. Real wealth isn't built overnight. It's a marathon, not a sprint. The real magic is in compounding, and that's a force that only works if you give it time. And number 4, and this might be the most important one of all, don't let your feelings make your financial decisions. Fear and excitement are terrible advisors. Your best defense isn't being a genius, it's having a process and sticking to it no matter how you feel. The calm investor always wins in the end. So when you boil it all down, Graham's real gift wasn't some secret formula for getting rich. It was a mental framework for staying sane in a crazy world. It's about building a lighthouse of logic and calm to guide you through the storms of market emotion. Which really just leaves us with one final thought, one question for you. Mr. Market is always going to be emotional. The only thing you can actually control is whether you will be too.